Hello traders, Gary Wagner with WFGForex.com, your daily market update for Forex Gold. It is Tuesday, the 27th day of July, and this is the daily report. Double-digit losses in Forex Gold currently. Currently, gold trading down about $20 at 11.59, 11.60, somewhere in that area. We have had an utter breakout to the downside. In today's report, we're going to talk about that activity, a little bit of the fundamental news that brought that on, but I think that this is, in essence, a technical move in nature. As we talked about yesterday, I had some real concern in that the market had been trading narrowly in this band, had broke down below this band, and was unable to really come up and hold any of these recent highs. We also talked about the fact that we had this two-day pattern, which is this dark cloud cover right in here, and on yesterday that was in fact confirmed. That is a bearish reversal signal. At the same time, it really didn't come after a long move up in the market, which is typically where we do see it. However, we absolutely have a breakout to the downside. Traders, when we take a look at this recent corrective A wave that we're witnessing, as you can see, when the market came down, as it tends to go through, it came through very, very strongly right through that 12.12. As we talked about yesterday, it formed a what we call a scouting party, in that it tried to test the fortitude, was unable to, on 3 occasions, take out these highs. It then broke down hard and much, much lower. It formed a base here. Here's another scouting party right in here. And here we had an utter breakthrough of this particular Fibonacci level at 1180, and in my opinion right now has nowhere to go but 1153. That's the 50% retracement. Our 61% retracement is down at 1127. Fundamentally, and this is according to Kitco News, S&P Case-Shiller's May 10 City Home Price Index was up 5.4% year on year. That report pushed gold prices to a fresh session low, and losses have since been extended. Gold traders did appear to shrug off a weaker U.S. Consumer Confidence Index reading for July. The U.S. dollar index moved higher on the Case-Shiller housing data. Investor risk appetite appears to be on the upswing. The one thing that we are looking at is we do have a fresh 2.5-month low right now, and technically our next real support level, as I said, has got to be right around this 1153 or that 50% retracement area. Technically, I think that this is going to be an absolutely critical area in terms of finding support, and I think that there's absolutely an actual opportunity that we might find support in this area. And let me explain a reason for my sentiment. I've done again what is called Fibonacci harmonics, in which I'm looking at 2 separate Fibonacci retracement sequence numbers and looking for points in which they come together. The one point that you're going to see is right in this area that we're looking at. I've got 2 Fibonacci numbers. I'm going to show you where they're both drawn from, 1156 and 1154, a 23% retracement and a 50% retracement. Now, where's the 23% retracement from? That's actually from the very first top that we received back in December of 2009. Let me show you that on the chart, traders. The Fibonacci sequence that I am looking at is based upon, if you notice, these series of lows here that are trading at around 940. And then I draw the top, of course, at this 1221. That's our first sequence. Our second sequence is from the beginning of this wave 1 and then the top of wave 5. When you put the two together, we're going to look for the points in which 2 of them come together or are very close, and we get this one point right in here. I think that that's something that absolutely is very, very interesting and is something we want to pay close attention to. As I talked about last week, the most difficult waves to forecast are always going to be the first within either the corrective phase, which is going to be your A wave in here, or wave one, the first in the impulse. The reason being is that we use the A wave as a benchmark to forecast amplitude on both our B and C wave in the same way that we use wave 1 to forecast amplitude in waves 3 and waves 5, and then we use Fibonacci retracement for these corrective waves 2 and 4. When we consider the kind of moves that we saw back in December 2009, we had the market go from 1221 down to about, call it 1077, 1080, somewhere in that area. And when you look at that move was a move of $141. Now, when we compare that to this current A wave, you've got a high of 1265, currently trading, call it 1260, so you've seen a move of about $105, roughly two-thirds the move that we have witnessed during that first historical high. And it's another way that we might want to look at the severity or the size or depth of this correction. Now, this correction, of course, took a lot longer. In other words, the market came down, it formed a base, it broke down below, it then again formed a base, and then today broke lower. What I want to look at is some standard trend lines that I believe are showing you that we are in an area which has some very, very defined history. The blue trend lines I'm drawing from some tops in the market. This one top, which was the top of our B wave. This one top right in here, and then these two bottoms, this low here and this low here. They come in quite close together, but one thing that you want to see on this cluster is that we do have a low right in this area, but we do have some very, very good technical history along with the Fibonacci retracement that is showing us that this marketplace on an interim basis, and we'll have to see how it reacts, but there is good technical reasons for this market to find some support. Traders, Elliott Wave has proved to be an exceptional and highly effective forecasting tool for us when we consider the past history and what it's been able to accomplish for us. Realize the A wave and wave 1 are the trickiest waves to try to take a look at. Simply put, we use them as benchmarks for the waves that are going to come after that. So that wave 1 we use as a benchmark. We times wave 1 in terms of amplitude, 1.61. That will give us a projected top. Our projected top on this was 1246. The actual top was 1248. We look at wave 1 in terms of wave 2 and look for an equal amplitude, $100 move. Add that to the bottom here, and you come up with 1265, which was in fact the absolute top. Now that we're in the A wave on our corrective phase, we simply are able to look at Fibonacci, to look at logical places for it to go. Right now, it absolutely appears it's going to head to 1154. We'll have to see if that holds support. There's some good rationale behind it. We were looking for this 1180. The market obviously took that out like a hot knife through butter. As you can see, these particular levels are 23, are 38, and our current 50% are levels in which the market wanted to trade to, and in these two cases below. So what would we be looking for? I'm still looking at the same basic forecasting in terms of where I think the market will go once we do find a bottom, whether the bottom is at 1154 or it's at 1128, which is the 61% level. If in fact it finds support here, the impulse wave is going to come up, take us about 50% higher. Then we will go into the final C wave. C wave on a standard zigzag will take us either to this 61% level, or it will take us to this 76% level, which is 1091 and 11, call it 1127 respectively. Those are the two areas that we would look for, and this is the kind of bounce I would be looking to see. Of course, if it cannot hold this area and goes to the 61%, we will look at a 50% move between this 61% level, which is at 1128, and 1265, which would give us a slightly different target. This has been Gary Wagner with WFGForex.com, wishing you, as always, good trading. Interesting day in the market. We will talk to you tomorrow. Bye-bye.